Welcome to TheoTrade. This is Don Kaufman, June 4th, 2021, doing the weekend update here on a Friday afternoon. The market's finishing the week ever so slightly higher, but asking the question, is this the start of a major upside breakout? We're actually going to answer that and much more here on this weekend update. First and foremost, what I would construe as one of the most important aspects in this marketplace. You're looking right now at the ES futures contract. This is the last 30 days on a 1-hour chart. The point that I wanted to make right off the bat here is we are still very much trapped in the exact same range. Now, there's absolutely unequivocally no question that we are at the upper edge of that range. But what I'm going to explain in this weekend's update is really what dynamic is going to drive trade moving forward. And it really is a very critical dynamic. I got to tell you, looking at a single chart is not necessarily, the depth that you're going to need to get a feel for this marketplace moving forward. In fact, one of the charts that we're going to be looking at a little bit more in depth is going to be involving bonds and interest rates, which is going to drive much of the trade dynamic. Before we get there, let me lay a little bit of groundwork for this with a quick market update. One of the first things we need to talk about, of course, is the jobs number. So today, Friday, we had of course, the monthly unemployment situation come out. The jobs number, it missed. When people get down to it, they start talking about the numbers, and it's 571,000 jobs, and the jobs number missed. I mean, the bottom line is the jobs number missed. Okay. And on that miss, now we're actually looking at the S&P futures on a 1-day, 1 minute. And the reason I'm using the futures contracts for this is because it really clearly delineates the job miss, we take off to the upside. And a lot of people, of course, are going to question that right off the bat, like, hey, wait a second. So we missed the jobs report. Yeah, of course. Then the market takes off to the upside. And again, we're back to Goldilocks. And if you're not familiar with that terminology of, Goldilocks is back, basically means this. We missed in the jobs report. It's the second month in a row that we actually missed. Some of the job revisions from the previous month, maybe a little bit better, neither here nor there. The bottom line with this is it simply says, hey, the economy is not necessarily recovering as fast as maybe, everybody had kind of hoped for, but at the exact same time, what it really means is the Fed has got your back, baby. That's the way the marketplace is pricing this. And as long as the Fed has our back, and that says they're going to keep their foot with, the pedal down. All right, that's what the Fed is ultimately going to do. They're not going to necessarily start taper bonds, the 120 billion, in bonds and mortgage-backed securities that they're buying every month. That's not going away anytime soon. And that's exactly the way the marketplace priced it. But the dynamic isn't necessarily, to just look at the S&P futures. What we're going to be doing here in a moment is looking at bonds. We're going to look at bonds. We're going to look at rates. I'm just kind of setting the stage for that right now. So what happens with the jobs number? Well, the jobs number comes out, it misses, and the market loves it. But we're going to be facing more of this dynamic later next week as like CPI numbers come out, because again, all of a sudden, the jobs number, well, that's not that good. But what happens if the jobs number isn't great, but we're still actually sparking huge inflation? Then the market dynamic switches on us again. It's like this merry-go-round again of horrible things that could possibly happen in the marketplace, and they're going to keep resurfacing. But one that you're going to keep hearing is you're still going to hear a lot about inflation or lack thereof. But for right now, the marketplace has Goldilocks, which is again effectively, we missed the numbers. The marketplace loves it because it implies that interest rates are going to be low for a substantial period of time. And I wanted to, expound upon that topic for just a moment. Next, financials and energy leading markets. Now, this is a dynamic that you maybe were not expecting. So if I bring up the financials, here's the financials. They have a little bit of a bid under them. But if you bring up auto expected moves, it kind of fully delineates, if you will, the financials are still not really breaking out to the upside. Listen, nothing really broke, if you will, in a big way, other than the energy markets. But in fact, again, the financials, they kind of led in terms of sectors this particular week. Now, of course, I could point out none other than, and I'm actually going to pull it up right now, the energy sector. The energy sector, okay, it did have just, an absolute, smash to the upside, the expected move. It literally did double the expected move. But the reason that I kind of put the energy sector to the back burner a little bit, the energy sector just isn't large enough to be, that market dynamic and that market mover. So the energy sector, absolutely unequivocally, it matters because energy plus financials, okay, can drive the marketplace just as much as tech, which actually brings me to the next, segment over here is to look actually at the QQQ. And the interesting thing about the Nasdaq, the Nasdaq almost touched the lower edge of the expected move, and we finished mildly higher in the Nasdaq on the week, but that right there, you need the Nasdaq, okay? You're going to need the Nasdaq to actually, continue, if you will, to break out, if you will, to the upside. And that's, again, it's part of the dynamic that we're going to be explaining here momentarily. So tech kind of lagged a little bit. And then, lo and behold, volatility kind of crushed down. All right, so a bit of a vol crush, but there's a lot more than meets the eye when it comes down to volatility. So the week at large, like you start to break this down, and again, we look at the S&Ps quite often. I'm actually going to bring up once again, that 30-day 1-hour chart. And I love this 30-day 1-hour chart because, people will constantly discuss, you got the MACDs and the Fibonacci's and the Bollinger Bands. They're looking at the charts till they're blue in the face. People, okay, you can do anything you want over here. We're doing nothing. Okay, we're doing absolutely unequivocally nothing. Yeah, we're towards the upper end of the range, but I've seen that movie before. I saw that movie before, right before we broke down. And again, I saw that movie back here right before we broke down. So just to the fact that we're at the upper edge of this channel right now means absolutely nothing. And I want to clarify that because when you start looking at it from the SPX point of view, let's cruise over to the SPX, the mother of all products. Okay, and we start to look at this, and I talk about this dynamic that we've been trapped in such an incredibly tight range. Well, let's look. How many weeks are we in? So we broke into the range here. So you got 1 week, you got 2, you got 3, you got 4, you got 5, you got 6, you got 7. That's 8 weeks, people. You are a full, pretty much 2 months into the exact same range. What do you get for that? Absolutely nothing, except if you're positive theta. If you've been positive theta, and we absolutely have, meaning that we've been selling options premium, it's been beautiful. It's boring, but sometimes beautiful and boring kind of go hand in hand. So with that, that's pretty much your market update. Volatility came down, right? Tech kind of didn't do very much until, well, today. Tech actually finished 1.7% higher, but net, you still had financials and energy leading the markets. Goldilocks is kind of back because bad news is, well, good news for the marketplace. Okay, now let's get to the important dynamic to kind of answer the question, is this a start of a major upside breakout? For that, we need to discuss a little bit about bonds. Okay, are the bonds starting to break out? Let's go to the bond chart. Now, first and foremost, if you go over to a bond chart and you're on the thinkorswim platform, or really if you're looking at bonds on any trading application, it's the ZB, and I like to look at the ZB. Sure, we could talk about the ZN, again, till we're blue in the face over here, but there's one thing you've got to be aware of. The bonds have a role, and that role has huge implications to the chart. So a lot of people, they run a lot of technical analysis on charts of futures contracts. And they're not aware of this. You need to actually come in here, go to futures, and go adjust for contract changes. Now watch what happens when I hit apply. Watch this chart right here. Hit apply, hit OK. What that basically does is it tells the thinkorswim platform to create a continuous chart. And continuous chart actually makes the chart, again, continuous in such that fact that it's like one contract, that role is kind of negated, and you absolutely unequivocally need this to get a feel for what the bond market is really doing. So, if you thought the S&Ps were in a tight range, oh man, look at the bonds. Even a tighter range inside of the bonds, but the bonds are right to the upper edge, just like the S&Ps. They're right to the upper edge, okay, of that really tight zone that they've been in. But the bonds, come on, they've been in there for what? You're March, you're April, you're May, you're into June. Right, so you're 3.5 months in the exact same range in bonds. Bonds, though, they're going to be the dynamic that you have to watch. The bonds rates drive market dynamics. And that's exactly what I'm going to kind of interpret for you right here, right now. So with bonds in mind, let's cruise over to the TNX. The TNX is the associated interest rate. Now, if you've never looked at interest rates before on a trading application, it gets a little confusing because right here it says, 15.6. That means 1.56. Okay, and this is on the 10-year. So I just jumped from bonds, but yes, we're talking about the 10-year. So that 1.56. So here's the dynamic. Okay, the dynamic is a very simple one. You got tech and you got financials. Now, one of those sectors loves high interest rates. The other one of those sectors hates high interest rates. Okay, so where are interest rates, okay, appropriately headed right now? If the bond market, which was up big league today, continues to break to the upside, this interest rate, okay, will head lower. So if the rate heads lower, and let's say that the 10-year is no longer here at 1.5, the 10-year, for instance, drops to like 1.3, that's a pretty significant amount. That should hurt, okay, the financials. The financials are not going to appreciate the lower interest rates, okay, to the marketplace. So in that scenario, the financials will likely be hurt. And we're right on the cusp of a real breakout. So long as the bonds have been in a range, the interest rates have been in a range. So long as the bonds have been in the range, the S&Ps have been in a range. But, okay, if this 10-year starts to really, starts to come off a little bit here and the 10-year interest rate comes down to like 1.4, 1.3, the financials could freak. And if the financials freak, well, hey, listen, that has been the leading edge of the marketplace. But at the exact same time, okay, lower rates, tech, okay, loves lower rates. So here is this back and forth kind of dynamic. Why does tech love lower interest rates? Tech loves lower interest rates. Their stock buybacks. I mean, it just lower interest rates feed the entire model, okay, of technology. And what's that model? I mean, the way to basically say it is, hey, okay, let's build, a trading application, if you will, in a low interest rate environment and put 300 million people on it, okay, and pay next to nothing on interest while we build, users. So for the most part, what I'm talking about in tech in general, it's the let's actually lose money. Let's lose money. Let's do it in volume, but don't worry, interest rates are low. So tech absolutely loves lower rates. Okay, this dynamic is actually going to bifurcate the marketplace very, very soon, which could have just some really wicked and complicated implications moving forward. I mean, you start to look at this. So if the interest rates, okay, really start to come off, financials are going to come in, okay? And when I say financials are going to come in, the financials themselves, all right, this is a sector that can start to come down. But if the financials come down unequivocally, the energy sector is coming with it because they're moving in relative lockstep. And if you haven't looked at this before, I'm going to bring you to the chart. We're going to go to chart. We're going to go add study. We're going to go to compare with, and we're going to cruise up to a custom symbol. And we're actually going to type in XLF. All right, so now you're looking at the financials versus energy. I think that one, I don't need to actually turn line chart to line chart. I think this is like enough said right here. Okay, that dynamic is, they're moving together. So if all of a sudden you start to get lower interest rate environment, all right, it's going to hurt the energy sector. It's going to hurt the financial sector. Okay, the question is that going to be enough to start to roll the marketplace over, or, all right, are the QQQs all of a sudden going to break out to the upside? And I'm going to tell you right now, I think actually the Qs will break out to the upside. The marketplace, though, in terms of the S&Ps, they may not have enough fuel, all right, to do much to the upside, which here, okay, is, again, one of the most important dynamics. And I'll actually clean this up, as you start to look at the S&Ps breaking to the upside, again, everybody's going to scream, all-time high, it's an upside breakout over here. The upside breakout that's going to occur in the marketplace, because I want to answer this question and not hedge around it at all. Is this it? Is this going to be the upside breakout? All right, it's already occurring. Again, it's already occurring that we're seeing a bit of an upside breakout. My assumption, at this point in time, okay, is that this bond dynamic, this is going to come in play, all right? And it's going to come in play probably like late next week. On the onset of this next trading week, we are likely to have gamma risk just pull us a little bit higher, okay? From here, though, this is the critical level inside of the S&Ps, okay, is going to be before we even hit 4,300. And quite frankly, all right, hitting in that neighborhood, and again, that's about 70 S&P handles away. 4,300 would be a critical level. If we were to hit that particular level, right, again, buying is going to cause more buying. It's literally this dynamic of a gamma squeeze that could be in play. However, as the marketplace starts to appreciate, that would be a lower interest rate environment. We could very, very rapidly roll over. So in short order, okay, to kind of answer some of this question here, like, is this it? It's the start of a major upside breakout. Absolutely, unequivocally, yes. However, I believe it's going to be limited, okay? And it's going to be wicked in terms of a reversal in the marketplace. So what we're going to have is we're going to have this dynamic where gamma grips hold and rips us to the upside, okay? Then all of a sudden, what we're going to feel is the bond market flip us back over inside of the S&Ps as rates, again, lower interest rate environment, which is wonderful for technology, okay, is also going to stall out the financials in large part. And again, there could be catalysts along the way, all right, but initially I'd look for a break to the upside, which is already occurring, followed by, again, a very violent move back down. From there, we're going to have to reassess. Are we going to be dropped right back into this range? Absolutely. The only path lower is to be dropped right back into this range that we've been in for the past 2 months. Now, with this, okay, so the bonds are breaking out to the upside. We explained the dynamic that, again, one sector is loving high interest rates, the other sector hates it, right? Then if we talk about lower interest rates, the techs absolutely love low interest rates, the financials hate low interest rates, and that is, again, it's going to bifurcate the marketplace to a degree. If trading that kind of dynamic ain't for you, well, guess what? Skew just continues to dominate. And if you haven't pulled this up lately, okay, Skew hit record levels this week. I'll just pull up like a 5-year record levels of Skew. So one of the things I wanted to point out, and I love this, like, because people don't really get Skew, markets are pricing in tail risk. Like, if you look at the S&Ps for what they really are, like, so you look at the S&Ps and they've broken to the upside. When I say markets are pricing in tail risk, the options marketplace, okay, has got crazy high, all right, implied volatility of way out of the money options, like way out of the money options, still crazy high implied volatility. And that is spectacular, okay, for premium sellers. Not to mention like the VVIX, and we could pull up the VVIX over here. I think it's still trading like the 108 handle. All right. So the VVIX, it's just in this, like, you know, right near this VAMA zone, which is north of 110, but we're still trading at an incredibly like high VVIX, okay, which is indicative of hedgers are still present. We're still pricing in tail risk because the skew is incredibly high, all right? But when you start looking, there's been a big volatility crush, but check out the options chains here. And I'll use the spiders to go a little softer, a little gentler on you. But in terms of the spiders, we'll kind of highlight some of the expirations. Front month stuff has been crushed. Like, look, that's like the Monday expiration, June 7th, Monday expiration. There's less than 7% implied volatility at the money. Okay, you go a little further out in time and you're like, oh, okay, so he's about almost a month out in time. You go a month out in time, we're still looking at like 15, 16% implied volatility. But if you actually opened up one of these option chains, the out of the money puts are trading for a huge, huge amount of skew. In fact, it's worth it. Like, take the time, open up a chain, right? Open up a chain, go to all, snap this over here to implied vol. Okay, look at some of the implied volatilities out here. Way out of the money options trading 30, 40% implied volatility. But I'm going to tell you right now, I'm actually selling some back month premium, because back month premium, you go out here like 77 days, you're still trading at about a 20% IV, but that's like near money implied volatility is like 19%. Look at some of the out of the money premium in here, 33%, 34% skew. It's magnificent. It's just absolutely magnificently large at this point in time. So premium sellers, okay, you're still pretty much, on the money, on the ball. If you don't want to mess with that dynamic against the bonds, okay, then go out there, sell some premium, but you got to learn how to mitigate that risk. And it's actually one of the reasons I bring up the VVIX, because the VVIX is high. It's actually making, all right, our hedges really easy, if you will, to put on inside of products like the VIX. Last but definitely not least, we talk about the SPX each and every week and the expected move in the SPX. Zooming into the SPX. So we're starting to see volatility really crush down in the SPX, but it's really crushing down just in the front month. One of the things I think that, at least for me, that is by far and away the most surprising, if you look right now at like the last 2 weeks of trade. So here we go. We never officially hit the edge of an expected move 2 weeks ago. This week we got close, but we never really hit the edge of the expected move. And lo and behold, the expected move for the coming week of trade. Again, everybody always asks me, where do you get that expected move from? Those are hand drawn. It's the June 11th expiration. It's about $53. So I've actually got it marked specifically at 53.14. So we just came off of a holiday week of trade, right? So we just had a 4-day trading week. Now, this 4-day trading week in here, in fact, I'm even going to zoom this in because I think this is such a critically important, portion of kind of understanding, risk in the marketplace. So we just came off of this 4-day trading week, and the 4-day trading week was roughly plus or minus $50. Now we're going into a full-blown trading week, and we're plus or minus $53, an entire another day, and yet they only pack in another $3 of premium over here. So what has gone on is that's because we're not tagging the upper or lower edge of the expected move. Now they're actually crushing out the short duration implied volatility, which I'm going to tell you actually makes, and this is a crazy dynamic again, the short term stuff, okay, like really short duration implied volatility, I'd actually be a buyer in short term. Okay, seller in the back month, buyer in the near month. That right now is the dynamic, okay, of those that actually understand, marketplace a bit. It's almost like a little bit of a dispersion trade going on. And again, I like where we're actually headed right now. And again, my take on the marketplace, my directional bias does not necessarily have to be yours, but I do see us actually getting a bit of the gamma squeeze, a kick to the upside that could be violent, followed by, again, a fast reversal because of that bond/interest rate dynamic in the marketplace. With that, that's it for this weekend's update. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.